Okay, this next section is looking at other things that you should take into account when you buy and sell shares, not just the break-even price. So there are other indicators that will give us a really good idea when to buy and when to sell shares. Also, just remembering that all these things give us more information, so the more information we have, the better we are at making trading decisions. The first one is the price-earnings ratio. Now this is shown in the share list every day, and basically what it does is shows the number of times that the share price covers the earnings per share. So if a PE ratio or price-earnings ratio of 14 for say BHP, what that means is it will take 14 years for the earnings from the shares to cover the share price. And this is also assuming that the share price remains constant and the returns, which is the earnings per share, is constant over this time as well. The ratio is commonly used to kind of ascertain whether a stock's relative value and therefore whether it's overpriced or underpriced. So it shows you basically, is this stock at this price good value, or is it overpriced, or is it underpriced? The calculation of the PE ratio is done by dividing the share price by the earnings per share, where the earnings per share is the net profit, which is the amount of money that the company's made, divided by the number of ordinary shares on issue for the company. So it's calculated daily, and sometimes in the share table, especially in the Australian, it's on the right hand side, sometimes in the advertiser it's not there. It's calculated dividing the market value of the company by its earnings per share. So as you can see, the PE ratio, share price, divided by the earnings per share. The earnings per share is calculated by getting the previous year's or the year before's net profit for the ordinary shareholders, and then dividing it by the number of ordinary shares. So there's another calculation there. So a high price-earnings ratio may indicate that investors are expecting a high growth in earnings over the future, but you can really only compare companies from the same industry sector. You can't really compare a bank with mining or something like that. Okay, so you need to have about the same. It gives you a general feeling of whether they're overpriced or underpriced based on their returns. So your earnings per share, just going back to this bit up here, the earnings per share is your net profit for ordinary shares divided by the number of ordinary shares. Now you'll normally get that embedded in a question, so you just need to solve that bit before you can work out the PE ratio. If the industry is a stable industry, something like a bank, then your PE ratio is probably going to be low. But if there's lots of speculation and movement in it, then the price-earnings ratio might be high. And this might be something like technology stocks or telecommunications or something like that, where there's speculation that there's going to be big growth, and then there are a lot of movement in the share price, and then the PE ratio may be high. Now it's handy to have like a table, and the table here will give us an idea about whether it's overvalued or undervalued. So if there's no price-earnings ratio, it means the company's made no earnings. 0 to 10 means that the company is either undervalued or the earnings have been predicted to decline. 10 to 20, reasonable value. 20 to 30, it's either overvalued or the earnings have decreased since the last annual earnings figure was reported. Or 30 plus, which is very high, is exceptionally good growth prospects, or there's been the subject of much positive speculation. So like a company's about to expand into a new mining area and they've found more minerals or something like that. Lots of positive speculation that something's going to go really well and that their value is going to increase, and therefore you'll have a PE ratio of 30 or plus. Market conditions will have a strong influence on the relative PE ratios, but it does give you a snapshot regarding the economic growth of the company. So it's not a bad one to kind of keep in the back of your head when you're comparing. On page 8, there are 3 questions to do, so please do them. The other thing you can do to work out whether companies are going well is look at company charts. We looked about this earlier on in the course, but here's another thing to do. Companies will produce charts showing you how your shares are performing. The Australian Stock Exchange, or ASX, has all the companies listed in Australia, all their charts there. You can also do it with Yahoo Finance and things like that, which we'll go through in class. They all have company charts. But there are a variety of charts that will be showing you what's going on, not just simple line charts that we looked at earlier on in the course, but there are some other charts that will show you different things about the market, which once again gives you more information, so therefore you can make a better decision. Candlestick charts are pretty cool. What they do is they give you more information than just a line graph. They give you the opening price, the closing price, the highest price for the day, and the lowest price for the day. And also shows you whether these shares have been going up or been going down. So the rectangular body here is the closing prices at the top, or the close and the opening price. If it's a green box, it means they're doing a profit. If it's a red box, they've closed lower over the day. So notice that if it's a green box, the close is the price at the top there, and a green box, the opening price is at the bottom. If it's a red box, which means that they have made a loss during the day, or the shares have gone down, the opening price is at the top, the closing price is down the bottom. For each of these, the highest price for the day is at the top of this whisker or this candlestick, or they call it the wick in this type of thing, because this is your candle. Then your wick here is also your highest price, then your lowest price, and your lowest price. So it gives you a good snapshot of what's going on. Red going down, green going up. So you can have a look at this graph here. If it's clear, nothing's happened on that day. If it's red, it's dropped in price. So you can see that these ones are moving around quite a bit here. So it's a nice little graph to be able to see what's going on just compared to a line graph, because it gives you a snapshot of how the trading is on that day rather than looking at a share price table. The other good graph which we would look at, which is very good to pay attention to, is the moving average. It's a widely used graph or indicator that determines a trend. Okay? If you look at shares every day, they can be going up and down all over the place, and sometimes it's hard to work out whether generally they're going up or generally they're going down, and also when to trade, when a good time to trade is. If they're going all over the place, how do you make a decision? If you can average out the prices over a period of time, then you can smooth the graph out, and then you can actually work out trends. So it's quite a cool thing. So it's called a moving average. Basically, it has a smoothing effect, and it can remove ups and downs by reducing the high and low cost bar graph to a simple line graph. I'll show you what it means in a minute. A simple moving average just uses the close price to calculate its value over a given time. Depending on the nature, different of what you're trading and what you're looking for will give you what time frames you're using for the moving average. So if we're going to do a 3-day moving average, you get the prices over the 3 days and divide it by 3, and you get the average price. Okay, so what it means is all these prices are going up and down, it smooths it out or averages it out over the 3 days. Then the next day, a new day is added, the oldest day is dropped off, and then it will go and find the average again. So the average is moving. That's why it's called a moving average. So the moving on one day, the second day average is 76 point. So you can see it here. It goes like that. So if you have a look at a table like this, which you can put into a spreadsheet, first 2 days we've got nothing there. That's your average. The next day, this average comes from 1, 2, 3, those prices there. And then when you get down to this day here, that's 1, 2, 3, those ones there. So every time we drop down a day, we drop another one off the top of it. So it works quite well. So it actually gets rid of the peaks. So if you have a look on the graph over here, there's one on the next page. That's the daily price going up and down all over the place. This is the moving average, which smooths out those peaks and troughs. When we have a look at one on the from the share market, this is BHP. The blue line is the All Ordinaries Index. The All Ordinaries Index is a graph of how the whole market is performing generally over the day. This purple line is a moving average for 20 days. And this red line is the BHP price during this time. So you can see that this 20-day moving average is a lot gentler, and it smooths out the peaks and troughs. Now, when to buy and sell? When your share price goes above the moving average, that's a good time to buy. That's a buy indicator. Okay, so here's BHP, she's going up. That's a good time to buy. It hits this peak and starts coming down. That's a good indication to sell then. Okay, because it drops below the moving average line. So if it goes up above the moving average line, you buy it. Sell on the fall. Now, as you can see from here, it doesn't come back up. But this is only a small snapshot, so you can actually look at it over a longer period of time. Here's another one that shows you the moving average as well. This is like a stick graph. It's got the highs and lows on it. But you'll see that the 8-day is still fairly volatile, jumps up and down like that. The 21-day, because you're doing a longer average, is a lot smoother. And the last one's the 55-day one, which is really generally high. So if you're doing a long-term investment, you'll be looking at the 55-day, shorter term for 21, and really short term for the 8-day. But you can see, you can kind of work out when to buy and sell. Here the price is above it, that's pretty cool. As soon as it starts dropping down, you'd probably sell it using that blue one. If you're looking for a longer term investment, heck, it hasn't even crossed above it, it's gone above it there, and then dropped down here. So you'd probably buy it here, because that's when the share price is going above it, and you'd probably sell it over here. So you can see that you still make a profit, but because the 55-day average is longer, it smooths out those peaks and troughs. Here's the other one, the BHP over a longer period of time. So the moving average is like that, the purple one. Blue one is all ordinaries, and the BHP daily one is that one there. So lots of places you could look at buying and selling. This is a good place to buy, here, and you could sell here. This is definitely a selling place. And notice how then, when it comes down to this trough here, gives you another indication of when to buy again. And notice if you buy down here and sell there, you've made a great profit. So that's the other time you'd sell, when it drops below that moving average line. So you can see that even though it fluctuates up and down here, up and down here, this stops you from doing this panic buying and selling because you're looking at how the graph is moving over time. There's one question to do on this. It's basically interpreting a graph. So if you could do that, that would just be terrific.